Hello, conscientious investors. The filming of this video is October the 5th, 2023, and there is a lot going on in the world of investing, so please allow me to bring you some year-to-date highlights. As usual, I'll do that in three parts. First, we'll talk about the stock market, and then we're going to talk about the economy, and finally, we'll wrap up with my recommendations on how to respond to all this data. So, without further ado, let's dive right in. Stocks started the year off pretty choppy with very few gains in Q1. Then in Q2, things shot off like a rocket. And finally, by Q3, some of those gains started to retreat and ended up being a pretty rocky quarter. October has been pretty much the same as September, with some of those earlier gains in the year continuing to retreat and increase volatility. It is worth noting that September and October are historically the two roughest months for the stock market, and that is no different this year. Now, the majority of cash deployed into the market this year has gone to two major places. One is money market accounts, and the other is mega cap companies. Mega cap representing companies valued over $200 billion. As of August 31st, money market funds reached an all-time record high of $5.58 trillion. As of last month, just 10 mega-cap companies made up 80% of the market gains. Now, it's worth noting that large investment holdings in money market accounts and mega-cap companies, this is an indicator of low investor sentiment. Subsequently, large caps are currently trading at a 20% premium compared to small and mid-sized caps, which are just small and mid-sized companies, which are trading at a 30% discount. Historically, when investors are sitting on lots of cash or safe investments, it's a good time to buy. Now, the Fed doesn't see a recession in our near future, and so they have actually penciled in one more rate hike before the end of the year. At this point, the Fed is forecasting a pause in interest rates at the beginning of 2024, followed by rate reductions after that. The global economy is undergoing a continued period of stagnation and may continue to slow, due in large part to ongoing economic woes in China. Now, the inflation rate rose from 3.2% to 3.7% from July to August, in large part due to surging energy prices. Now, in my humble opinion, very few media outlets are being honest about the true source of inflation and the bind that our economy is in. The shutting down of the American economy and the printing of $5.2 trillion of cash is the obvious reason. By contrast, in today's dollars, we only spent $4.7 trillion on World War II. Margin and patience are your friend, not fear. Remember your purpose for investing and keep your eyes on the prize, not the bumps along the way. And for the love of Pete, quit clicking on all that fear-mongering garbage that you see online. People literally get paid to write headlines that attract a lot of clicks. It's called clickbait for a reason. If you're not getting S&P 500 returns this year, it's probably because you don't own an S&P 500 mutual fund or ETF. And if you didn't own one during the run-up, don't bother buying one now because that ship has sailed and it's really expensive now. It could also be that your portfolio is more diversified than owning just large American companies. Now, remember that diversified accounts tend to make less in bull markets, but they also lose less in bear markets. They are consistently good long-term performers when done right because year over year, they're usually winning in one area or another all the time. Continue to dollar cost average because remember, it's about time in the market, not timing the market. Dollar cost average just means that you're buying into the market all the time when things are up and when things are down. When the market's up, you're glad because your money is growing and you're excited that it's growing. But when the market is down, still be glad because know that you're purchasing in at a better price point, you're getting the market on sale. Buying and selling based purely on economic indicators is a strategy guaranteeing subpar results. That's all I've got for you today. If you found this video helpful, please share it with a friend and don't forget to hit subscribe. If you'd like to connect with me, you can visit me at my website, www.matthewjholt.com, and schedule a complimentary consultation. Until next time, may you be blessed to be a blessing.